I recently met with a doctor who is interested in whole life insurance for the cash value. Now, she's 58 years old and she's looking to move about $600,000 into this policy. And we originally looked at illustrations that showed funding a policy over a period of 10 years. The thing that she said is, I'd rather get the funding done with. She doesn't really feel like continuing to add money to a whole life insurance policy. So what I'll go over is first what we looked at, and then an alternative that gave her a lot more money. So what we've got up on the screen is a policy with Guardian, which is one of the 4 major mutual companies. And this is the original plan. This is what we initially looked at, which she was interested in. So what we've got in terms of the funding is $100,000 years 1 and 2, followed by $50,000 per year thereafter through the 10th year. Now, they like Guardian because Guardian is 1, a major mutual company, and then 2, is very, very flexible. So how much do you see going in the first and second year? $100,000. They're not committed to that. Their premium is up here. They also have the cost of the term insurance rider. If we add those together and round off, it's about $10,000 per year, which is their minimum. So they can set it up where they are only billed for the minimum, and then they can add the rest of the funds 100% at their leisure, and they're not even required to add the additional funds. So it's very, very flexible in that regard. But when we look at this illustration, it looks pretty good. We've got a standard non-smoker rating, meaning not preferred. By the 3rd year, she's funded about $300K, and her break-even point is year 4. She's got more than $300,000. So this one looked good, but then in speaking with her, she did say, I'd like to get it done with respect to the funding. She likes the idea of the cash value being a safe place to grow her money. She can access it anytime she wants, and the tax benefit is extremely attractive to her and her husband because they're both physicians, they earn a lot of money, so they're paying a lot of tax. So here's what we looked at. First, we've got the illustration that we just had up. There's the minimum, right around 10K. Then you see the PUAs going in for the total annual funding in blue. And then the total funding over a period of 10 years is $600,000. We looked at a couple alternatives. Here's the one that looked the best. So we've got the exact same product with Guardian. The difference is we are condensing that funding over a period of 3 years, which at her present age, 3 years is optimal. If she was a little bit older, it might make sense to spread this lump sum out over 4 years. Your age does have an impact with respect to how quickly it makes sense to move money into a life insurance policy if you like these short funding examples. But when we look at this, what do we see? Well, the minimums come up a little bit. The all-in minimum is about $19K. And the first year deposit is $250,000, followed by $175 years 2 and 3. Now, is she committed to that? No. While this is the plan, how we will set the policy up is in a manner where she'll only be billed for $19K, and then she could add the PUAs at her discretion. She'll probably add it all up front every year, but we did want to build that flexibility in. So what do you see as a result? Well, the first year cash value is much richer because we paid more money in, but what I'm talking about is the percentage. So the example to the left, we don't need a calculator for this, but I'll still go through it in case you haven't done this before. If your first year cash value is $87,942, you can take that dollar figure and divide it by what you paid into the policy in the first year, which in this example is $100,000. And that gives you 87.9% cash value relative to your payment. So you're at just about 88% cash value in the first year. That's a 12% loss. Now, in an example where we are looking at a lump sum in the first year, you can make that a bit more attractive. So if you do the exact same thing, 226,090 divided by your payment of $250,000, look at this. Now you're above 90% in the first year. And if they really wanted more upfront, you could structure it to have a bit richer cash value too. My point is, a lump sum in the first year can boost the upfront cash value from a percentage standpoint, and it also improves the break even. Now, they both break even around the same time, but I would argue that the first example is really year 4, whereas the second one is between years 3 and 4 when we look at it. But anyway, they're very close. But if we look at the difference in performance, because you've got the exact same product with the exact same company, what's the actual cash value difference? Well, by the 10th year, if this is you, you've paid $600K in both examples. The difference is the example to the right. You got it into the policy over 3 years. So as we look at the difference in value by the 10th year where the out-of-pocket is the same, you've got more than another $40,000 in cash value as a result of putting it into the policy faster. And then moving forward, when you do nothing, that gap just gets wider. And the other thing is, if she wanted to keep adding money here, she could. But that's not the plan. She really liked the idea of funding it over a short period of time. Anyway, the purpose of going over this is really just to show whenever we work with someone who's interested in whole life insurance for the cash value, perhaps they want to leverage the cash value. This couple does want to use it for real estate, their business, and other things that they have in mind. That's always the fun part. However, what helps is talking through an individual's current situation, seeing what their current finances look like. This couple has a lot of liquidity and they really like life insurance. So the idea of moving it into a policy faster is very, very realistic to them. And then when they see this, it creates that situation where they're like, I didn't know you could do that. I can fund a whole life insurance policy for 3 years. I thought I had to pay into it my whole life. That's the name of the product. And if I fund it over a shorter period of time, I have more money? Yeah, you do. Okay, this is fantastic because what it does is give them more cash value from start to finish, which now they can use that cash value for other opportunities, the fun part, but now they've got more working capital. So a lot of times when we're working with individuals, everybody's always excited about the cash value, how to get as much of it as possible and how to use it. But as we work with them, my favorite thing to do is really just learn more about them, their goals, their current situation, and see whatever we're looking to put into a policy, can we make that better? And if they're like, I don't know, then what I'll usually do is just start by throwing ideas at them, which really emulate what others have done in a similar position to them. That keeps it simple and they're like, oh, I never thought about that. Anyway, I hope you enjoyed this video. I had a ton of fun with this couple and putting this video together. If you have any questions, comments, or thoughts, please feel free to leave them in the comments below. And as always, I hope this helps.